Hello everybody, welcome back to our XII-A classes. So let's resume our direct taxation and international taxation classes. So we are in the end of completion of this chapter, the assessment of non-residents. So let's complete the remaining portion of this chapter. So we'll start from section 44C, deduction of head office expenditure for non-residents under section 44C. Okay, so the expenditure nature of head office expenditure is allowable if of the lower of the following. Okay, so 5% of the adjusted total income or the amount of so much of the expenditure in the nature of head office expenditure incurred by the SSC as is attributable to business or profession of the SSC in the India. Whichever is lower among them, we are going to take the deduction. So you will get the non-resident will get the deduction. Okay? But now we have to understand what is the meaning of adjusted total income. So let's go. Adjusted total income, the total income without giving effect to the head office expenditure, unabsorbed depreciation, capital expenditure and family expenditure, losses carry forward, in which there are other losses under section business loss under section 72 subsection 1, speculation business losses under section 73 subsection 2, LTCL STCL under section 74 subsection 1, and losses and horses and maintaining, this is horses and maintaining horse race of section 74A subsection 3. Okay, and the last one, deduction under chapter 6A from GTA. Okay, so we are going to take the 5% of adjusted total income or the actual amount which was actually incurred by the SSC. Whichever is lower, the expenditure in nature of head office expenditure would be allowable as deduction under section 44C. Is it clear? Hope this was clear to you. Now we have to understand what is the head office expenditure. Okay, so executive and general administration expenditure included by non-resident outside India, okay, which include rent, rate, taxes and all, insurance, salary and all. Let's read out. So they are saying that rent, rates, taxes, repair, insurance or any other premises outside India, okay, used for business or profession, salary, wages, perquisite, etc. to employee or any other person managing an affair of the office outside India. Okay, so traveling expenditure by employee or any other person managing the affair of the office outside India. Okay, and such other executive of general expenses, administrative expenditure prescribed. Okay, hope so this was clear. But what if we told that 5% of the adjusted total income or the amount which was actually incurred, which is lower, would be allowed as deduction for the non-resident. Okay, but what if the adjusted total income actually comes in negative amount? In that case, we'll take the average adjusted total income of 3 years. Okay, let's go what I have written. Let's check out. If adjusted total income is a loss, which means in a negative, okay, then 3 years average adjusted total income shall be taken. Hope so this was clear. Now there would be capital gain taxation, okay, in case of non-resident. But when? First of all, if that capital asset is situated in the India, okay, and that transfer took place in the previous year, then only capital gain shall be taxable in the hand of non-resident. It was clear, hope so. Okay, so let's go for the some of the transactions which are not recorded as transfer in case of NR. Okay, we have already read in this in the capital asset, in the capital gain chapter. Okay, so let's go and check out what are the other remaining points which is saying that these transactions are not recorded as transfer. Okay, number first is saying that transfer of shares held in Indian company. The transfer of share held in Indian company by whom to whom? By the transferee, which means by the amalgamating company. Which company? Amalgamating foreign company. Okay, to amalgamated foreign company. Transfer of share which is held in Indian company by the amalgamating for foreign company to amalgamated, ठीक है, to foreign company. Okay, so this was of the shares held in Indian company. These again point saying that transfer of share held in Indian company by earlier it was amalgamating company, foreign company. Now it's they are saying the by the demerged foreign company, by the demerged foreign company to the resulting foreign company. Okay, hope so this part was also clear. So let's go see the third point, which says the transfer of bond. Earlier it was transfer of share which was held in Indian company by amalgamating foreign company to amalgamated, ठीक है, to the demerging to the resulting, ठीक है. So hope so this point was clear. Now let's go and check out which is saying the transfer of bond, ठीक है, GDR or rupee denominated bonds of Indian company. Again transfer of bond, ठीक है, GDR or rupee denominated bond of Indian company, okay, by a non-resident to another non-resident who is actually outside India. ठीक है, hope so this part was also clear to you. Now there are some special provision for computation of capital gain under section 48, first provision of section 48, which says the transfer of share or debentures, transfer of share or debenture of Indian company by whom? Definitely by the non-resident, ठीक है, by the non-resident, okay, but this is going to be applicable only if the non-resident acquires such capital asset in the foreign currency, not in the Indian currency. Is it clear? Let me say it again. Transfer of share, first share, transfer of debenture, ठीक है, of whom? Of the Indian company, by whom? By the non-resident, ठीक है, but that transaction the non-resident should acquire that capital asset, these capital asset only in the foreign currency, not in the Indian currency, ठीक है. And one more point, they are saying that this is only going to be applicable if TTBR and TTSR is given in the question. Okay, otherwise this point is not going to be applicable. First of all, the transfer of capital asset should be in the foreign currency, not in the Indian currency. Then TTBR and TTSR should be given in the question. Okay. Now TTBR stands for telegraphic transfer buying rate of State Bank of India and telegraphic transfer selling rate, TTSR, okay, of the State Bank of India. So hope so this point was clear to you. Okay. Now what is calculation? We know how to calculate the capital gain, ठीक है, we know how to compute this, ठीक है, which is similar to capital gain chapter. Now let's go and check out. This is almost similar to capital gain chapter, but there is one point added, which is TTBR and TTSR. That's it, ठीक है. So we have to take the average of TTBR and TTSR. Okay, so let's check out calculation of capital gain in foreign currency. Okay, but this is not going to be applied in case of equity share under section 112A. Okay, equity share under section 112A will not going to be applicable, ठीक है. So let's check out. Sale consideration in foreign currency is to be taken, but average of again TTBR and TTSR on the date of transfer. Sale consideration, ठीक है, यही करते थे ना, sale consideration less the transfer expenses, right? Then we'll again less cost of acquisition and all, improvement and all, ठीक है. So let's check out whether we are doing same in this case or not. First of all, sale consideration is going to be same, ठीक है, but average of TTBR and TTSR on the date of transfer is going to be taken, ठीक है, from which we have to deduct transfer expenses. Again, average of TTBR, TTSR is to be taken, ठीक है. Next, we'll get the net sale consideration, ठीक है, from which we have to deduct cost of acquisition in foreign currency, which again average of TTBR and TTSR is going to be taken on date of, but here on the date of acquisition is going to be taken for calculation of cost of acquisition. For other we were taking TTBR, TTSR on the date of transfer, ठीक है, but in case of cost of acquisition we are going to take the average of TTBR and TTSR on the date of acquisition, ठीक है. Hope so this part was clear. So we'll get STCG or LTCG in foreign currency, and at last we have to reconvert this STCG and LTCG in the Indian rupee by TTBR on the date of transfer. Again, only TTBR, only TTBR. We're not going to take TTSR in this case. Okay, let me say it again. We have to take the, what are we going to compute? Capital gain in foreign currency for non-residents. Okay, sale consideration is to be taken, average of TTBR, TTS on date of transfer is to be taken. Okay, less transfer expenses, again average of TTBR, TTS on date of transfer. Okay, we'll get the net consideration. From net consideration we have to deduct the cost of acquisition. We have to deduct the cost of acquisition, but no indexation is going to be happen. Okay, second part, average of TTB and TTSR, but on which date? Cost of acquisition. Okay, we'll get the, and these things are to be done in foreign currency. Okay, and at last when we get STCG and LTCG, we have to reconvert into the Indian currency only, but only TTBR we are going to take that, TTBR not TTSR. Hope so this part was also clear to you. Okay, let's go for, there are some provisions which are given for the non-resident Indian. I'm not talking about the non-resident, I'm talking about the NRI people. Now who are these NRI people? है ना? NRI people are those who are having the Indian citizen. ठीक है? Let me write out which are having the Indian citizen, and plus they are non-resident. Is it clear? Or the person of Indian origin. ठीक है, person who is of Indian origin and plus he is a non-resident. ठीक है, those people are going to be NRI. ठीक है, so let's go and check out the NRI by transferring the foreign asset. Now we have to find out the meaning of foreign exchange asset. Foreign exchange asset. ठीक है, so once they transfer this foreign exchange asset, they'll get what? Either they'll get the interest, investment income, or and long term capital gain would be arise. ठीक है, when the NRI transfer the what? The foreign exchange asset, they'll get the investment, what is going to arise? The investment income and capital gain. ठीक है, long term capital gain. This section is only going to apply in case of long term capital gain. ठीक है, so once this is going to a long term capital gain is going to arise. Okay, now I have to understand what is the meaning of foreign exchange asset. ठीक है, so for following asset purchase in convertible foreign currency. ठीक है, we are going to take only the asset which are purchased in foreign currency. ठीक है, so the asset purchase in convertible foreign currency, either they would be share of Indian company. First of all, share of Indian company, debenture deposit of Indian public company, ठीक है, or central government security. These are going to be the foreign exchange asset. Is it clear? Hope this part was clear. So if the NRI transfer this foreign exchange asset and what they get in return, the investment income. ठीक है, investment income from this foreign exchange asset. ठीक है, by transferring foreign exchange asset, what are they going to get? If that is share of Indian company, then they are going to get the dividend. The NRI going to get the dividend. But what about the debenture deposit of the Indian public company or the central government security? In that case, they are going to get the interest. In that case, they are going to get the NRI is going to get the interest in case of debenture deposits and central government securities. ठीक है, so once the NRI transfer these foreign exchange asset, ठीक है, which is purchased in convertible foreign currency only, ठीक है, in that case investment income is going to arise in form of interest or what? Dividend. ठीक है, and long term capital gain is arise. ठीक है, in that case only these section are going to be applied. ठीक है, which section 115C, 115I. ठीक है, let's read out now. So LTCG means the capital gain from the transfer of long-term foreign exchange asset. We know this. Okay. There are some exemption on LTCG if sale consideration is invested. Okay, that sale consideration is invested on other foreign exchange asset. Okay, other foreign exchange asset, but within how much time limit? Within the 6 months from the date of transfer. Within 6 months from date of transfer. Okay, transfer 6 months. Okay, so let's take out the exemption amount. We know this again. Okay, which is long term capital gain into investment in new foreign exchange asset upon net sale consideration. Long term capital gain into investment in new foreign exchange asset upon net consideration will get the amount of exemption. Okay, if new foreign asset is transferred within 3 years of acquisition, then no exemption allowed. Earlier shall be taxable. Earlier which was given exemption will be taxable as LTCG. Okay, hope so this part was clear. But there is no need for this NRI to file the return if NRI income consists of only investment income, and LTCG from foreign exchange asset, and TDS has already deducted on such income. Okay, hope so this point was clear to you. Now investment income, for the investment income 20% tax is chargeable, for LTCG 10% is chargeable, and for the other income it is as per the normal provision. Okay, hope so. Again let's go for some of the special tax rate for non-resident. In case of non-resident, we are going to read it very quickly. Okay, section 111A says about the STCG on certain assets, so that would be tax rate would be 15%. Section 112 for section 112A, okay, LTCG, that is going to be 10%, but up to 1 lakh would be exempt. Up to 1 lakh would be exempt. If it exceeds, then the rate would be 10% for long term capital gain. Is it clear? Hope so this part was also clear. Under section 112, earlier we read about the 112A for the long term capital asset, okay, and 112 says about for the other assets it would be 20% chargeable. Okay, for 115 BBF, royalty from patent developed and registered in India, that is going to be taxable at the rate of 10%. For 115 BBG, income from transfer of carbon credits is going to be taxable at the rate of 10%. Hope so this part was also clear. Section 115 BB says about the winning from lotteries is going to be taxable at the rate of 30%. Okay, section 115 BBJ, winning from online game, is also going to be taxable at the rate of 30%. Section 115 BBE is about undisclosed income, that is going to be taxable at the rate of 60%. Okay, for the Indian black money, yes. And section 115 BBH, which is of income from transfer of virtual digital asset, would be taxable at the rate of 30%. Section 115 BBC, anonymous donation would be taxable at the rate of 30%. 115 BBI, specified deemed income of trust, would be again taxable at the rate of 30%. Hope so this part was also clear to you. Now let's go for the other tax rate on interest and dividend income of the NR and foreign company. Okay, section 194 LB says about the interest when the non-resident or the foreign company receive the interest from the infrastructure debt fund. In that case 5% would be taxable, okay, in hand of NR or FC. Okay, section 194 LBA says about the distribution of income, interest income by whom? By business trust from SPV to non-resident. Okay, business trust to non-resident unit holder. In that case again 5% would be taxable in hand of. Okay, hope so this part was clear to you. Okay, section 194 LC says about the interest payable by Indian company or business trust to non-resident Indian company to business trust. Again earlier it was from business trust to non-resident unit holder. Now they are saying about the interest payable by Indian company or business trust to the non-resident. Okay, that would be again taxable at the rate of 5%. and that borrowed by them, which is to be borrowed by them in foreign currency under loan agreement made on before 20th-6/2023. Okay. Now section 194L, this is about on interest payable between 1/6/2023 and 30/6/2003. ठीक है, on rupee denominated bond, government security, municipal debt security, 5% would be chargeable. Okay. Section 195 says about the interest from government or Indian concern on money borrowed by them in foreign currency, that is going to be 20% taxable. Okay. Or any of the dividend income is received from the Indian company, okay, or unit located in IFSC. Okay, for the Indian company, that is going to be 20% chargeable. Okay, but if that dividend income is received from the unit which is located in the IFSC, in that case 10% would be taxable. Okay. Now income from unit of UTI mutual fund, that is going to be 20% chargeable, taxable. Okay. So what are they saying? 195 says about the interest from government, ठीक है, or Indian concern on money borrowed, okay, by them in foreign currency. In that case, 20% is going to be taxable. Dividend income from either Indian company or the unit located from the Indian company 20%, and or from the unit located 10%, or the income from the unit of UTI mutual fund, that is going to be 20%. Hope so this part was also clear to you. Section 115AB says about the income from unit of UTI mutual fund to overseas financial organization of shield funds. In that case, income from unit of UTI mutual fund is going to be taxable at the rate of 10%. ठीक है. LTCG on unit of UTI mutual fund is again going to be at the rate of chargeable at the rate of 10%. Section 115AC says about the income from bond or GDR or Indian company purchasing foreign currency by NR when they receive interest, dividend or LTCG arise on such transfer. In that case, the tax rate is going to be 10%. Hope so this part was also clear to you. Okay. Section 115AD says about the income in respect of securities other than unit referred to section 115AB. Okay, which is notified foreign institution investor of specified fund. In that case, for foreign institution institution, that case 20% is going to be taxable, and for specified fund it is going to be 10% taxable. Capital gain on transfer of such securities. Now let's go for the other. We know this STCG under section 11A is going to be 15% chargeable. Income by way of interest is referred in 194 LD is going to be 5% chargeable. Other STCG is going to be 30%, LTCG 10%. And income arising from the transfer of LTCG CA transfer to in section 112A exceeds 1 lakh. If it exceeds 1 lakh, in that case it's going to be 10%. Okay. These which we have to actually retain the rates of these institution and all. Okay. Now let's go for the section 115BA, which is non-resident sportsman being foreign citizen. Okay. Now if the income from received by non-resident from participation in the games sports which is held in India, ठीक है, if the non-resident is getting the any of the in form of remuneration or in getting any amount from the India for participation in game and sports in the India, ठीक है, that non-resident is a sportsman, ठीक है, or they have given any of the advertisement, ठीक है, in India, ठीक है, or for India, okay, or contribution of article related to any game or sports in India in newspaper, magazine or journal. In these three cases, 20% is going to be chargeable, ठीक है, from non-resident who is sportsman being foreign citizen. Okay, either he have taken participate in the game or sports which is in India, or given any of the article, ठीक है, contributed any of article related to any game or sports in India, or have given any of the advertisement, ठीक है, in that case 20% is going to be taxable. Now non-resident sports association, any amount guaranteed to be paid or payable to such association or institution for any game sports played in India, that would be again 20% would be taxable. Okay, non-resident entertainer being foreign citizen, now they are entertainer. Earlier we were talking about the sports person, okay, they are now entertainer. Any income received or receivable from his performance in India, again 20%. For every case about the sportsman or the entertainer or association being a non-resident, okay, then 20% would be tax applicability. Okay, if the SEC need not to file return of income if his income consists of specified income only, ठीक है, with specified income, the specified income, ठीक है, if the non-resident is having earning from India or from the specified income, in that case the non-resident need not to file the return. Okay, and there is one more condition which is saying the tax on such income has been deducted at the source. In that case the non-resident need not to file the return. ठीक है, hope so this part was also clear. Let's go for this section again. We know this bit about this section. Section 115 JB says about the applicability of MAT on foreign company, which says royalty and FTS if foreign company having the PE in India, ठीक है, if they are having the PE in India and if they are not. So if the PE is in the India and if the PE is not in India, ठीक है. So let's go and check out again what I have said. In section 115 JB, the applicability of MAT on foreign company is going to apply when the royalty and FTC, ठीक है, is from India, ठीक है. But if the foreign company is having P in India or not in India, in that case, if they are having P in India, taxability at the rate of 40% only if under section 44DA are followed, ठीक है. In that case only 40% would be chargeable. But what if there is no P in India? In that case tax would be under section 115A at the rate of 20%. If they are having P in India, 40%. Not P in India, 20%, ठीक है. And this part is going to be included in MAT calculation. Hope so this part was clear, ठीक है. But what about the interest dividend under section 115A? The rate, tax rate less than 15%. If the tax rate is actually less than 15%, in that case that would be excluded from the MAT calculation, ठीक है. Hope so this part was clear to you, ठीक है. So this was the completion of assessment of non-resident. So we have completed this chapter, ठीक है. So congratulations to us guys, we have completed the international taxation majority part, I guess all of the parts. Now we have to go and complete the chapters of direct taxation, ठीक है. So we have to, you know, level up our speeds also. So I'll be keep uploading the videos and hit a like button if you like my video, if it is actually useful for you. And that's it. This is Soumya Santosh. We'll meet in our next video. Till